Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, guys, I have a very special presentation put forth to show you something that I've come across, and I'll give you my thesis for my big short against US utilities play. If you haven't already liked and subscribed, I'll greatly appreciate you doing so, and we'll get into it. So this trade is one that I actually got from Fergus Cullen originally, who I believe got it in turn from Robert Mullin, and I'll be going through and showing you the thesis as to why, and then the exact particulars as to how I've added a little twist to Ferg's trade will be available for ROI Club members. So today, a disclaimer, guys, I'm not a financial advisor, as you know the drill. Nothing that I say here is advice. It's just what I'm doing and what I think. It might be right, it might be wrong. You need to decide for yourself and get the appropriate advice. Okay, so please don't take any action on what you hear today just because I said it or someone else said it. You're responsible for your situation, and I'm not an advisor, and this is not advice. It's just my opinion. So housekeeping out of the way. Today, we're going to cover the short thesis against the US utilities and how to profit from a falling market. I think they're going to be the last shoe to drop in this cyclical downturn that we've seen. I'll be providing my rationale from a macro, meso, and micro point of view. I'll be showing you what I'm doing in terms of the eToro portfolio to capitalize on this. And for the ROI Club members, I've added a little twist to a trade that I learnt. And so ROI Club members will be getting a potential chance to trade, to make a trade with 300% payoff and a 30% probability of profit by the end of the year. So I'll show you what I'm doing. Again, it's not advice, it's just what I am doing. So let's take a look. Macro, as we all know, credit conditions are tightening, okay? And they're tightening very sharply. The risk is off for most people, and almost everything is just getting crushed at the moment, especially anything with sort of fixed income exposure. Bond yields rising, and people are taking a hammering in terms of the nominal pricing on bonds. If we take a look at three main index that people follow, we've got the SPY, the Russell, and the NASDAQ proxies here. They're all down double digits on the year. And so if you look at that versus the utility sector as measured by XLU, utilities somehow are up 12.7%, which is very, very strange, especially considering that bond yields are rising. So I think that this doesn't make sense, and I think that it could be potentially an opportunity. So if we go back to the last time the Fed funds rate, excuse me, the 10-year yield in the light blue here. Okay, so that's the yield. And recently you've seen how steep some of those inclines have been. If we go back to the last time where yields were at this kind of level, the utilities were trading around $48, or this particular sector. And so the question is, are we about to see potentially a 50% drop, not quite 50%, but almost 50% drop in the utilities, given how sharply things have corrected? It's important to note the relationship between the 10-year yield and these utilities. These utilities have traded more or less as a bond proxy. And so what's happened has been people have been starved for income because yields have been so low in the previous environment. And that's all starting to change. So previously people were getting nothing on the 10-year. They were getting a sort of, 1% return on the bonds. And so they decided to throw a lot of money into the utilities because they had a huge payout ratio. So you'd be getting a dividend yield. I think the trailing 12-month dividend yield is something around 3%, a bit less than 3%. That doesn't sound like much, but it's obviously a lot better than 1%. However, obviously, we've seen conditions change recently. So look at the difference in terms of the yields as they start to rise. And yet these utilities haven't been sold off to the degree that you would expect. Why are you going to be sitting in a utility for a 2 to 3% dividend yield when you can start to invest in a 10-year that's already trading close to a 4 handle in terms of the yield? It doesn't make sense. If we take a look at, I guess, a more technical view, Here you can see this darker blue line down the bottom is a 200-day moving average for XLU. And traditionally, what happens is, due to the momentum of the algorithms of trading robots around the world, once an asset breaches that 200-day moving average, it can have really significant drops. And we are, as you can see, right on the cusp of that happening with XLU. So if we go into the meso, we've said that macro, anything around the world that's not producing a hell of a lot of yield, particularly free cash flow yield, is just getting smashed. Why the utility sector? Well, I think they are right for a short, because they're trading as a bond proxy, but they've got equity risk and they've got equity multiples. So, I'm going to show you in a minute NEE, which is a major holding in the XLU utility, that's trading at like 20 times EBITDA, and it actually doesn't have any free cash. Like, it's negative free cash flowing according to the reports. So you've got, on top of that, you're paying a hell of a lot for something that's making no money, but they're dishing out a dividend yield. So it's obviously unsustainable. The fundamental risks are the fact that they've also got a lot of debt on the balance sheet, so they're highly levered. They've been inefficient allocators of capital. They've tried to use solar and wind to generate a lot of power, and unfortunately that hasn't worked. They've got high PE multiples, and as I mentioned, low or no cash generations in some cases. This is the key. They are in a real squeeze here because utilities cannot pass on the cost. In many places, not only is it unpopular to pass on the cost by increasing utility bills, but it's also illegal. So they're in a huge bind. They cannot simply raise prices as a way to help themselves out of this mess. Article from Bloomberg: more than 20 million American households have fallen behind on the utility bill, about 1 in every 6 homes, and the amount they owe has doubled since before the pandemic. People are owing more money. Utilities are getting more aggressive about cutting off delinquent customers. So I guess if you're an insurance company or a financier, you'd look at this as a non-performing loan or as a default. And at the end of the day, they can cut off the utilities, but the utility companies are the ones that are going to wear the losses financially. And so I just think that for some reason, they've been a very slow boat to turn in this economic downturn. And I think that they're really ripe for a short. So if we take a look, European utilities versus US utilities versus the 10-year yield, okay? So these guys, these are the utilities here. They have been floating along just fine, only because look where the 10-year yield was, okay? It was super low. When you see things start to cross over and rise, you see they start to trough out. And so we're at here, if you notice, we're at that crossover point once again. So we're just starting to see what I think will be the catalyst for a decrease in price performance for these particular sectors. Every time they've crossed over, you've seen that inverse relationship start to spread. Okay, let's take a look at, excuse me, the XLU and the multiples you're paying for this absolute dog. So not only is it not, it's not generating much in the way of free cash, even if you look at EBIT, which is much higher up the income statement, you're still paying, you're paying nearly 49 times last year's earnings before interest and tax. So I don't know about you, but that is not investment grade for me. I want to be paying like, 1 to 2 times, which you can get in some of the coal investments that we've made. 49 times is just ridiculous. And yeah, it is a little bit lower if you use the next 12 months. But that's based on assumptions that they're going to get those earnings. And I don't think that they will. 2 little images here. If you look at the holding, so what's in this thing? When you look at an ETF, you've got to know what is in it, obviously. And the biggest weighting by far, as you can see here, is Nextra Energy. Okay, so what I've done in Ticker Terminal here is pull up some, back of the envelope using the quarterly reports here and the quarterly numbers. So if you take a look at how much you're paying in the next 12 months, as I mentioned, it is lower than 49 times, but it's not much lower. You're still paying ridiculous, like 35 times EBIT. And with a company that is churning cash, as you can see here, it's expected to have negative free cash next year with a 2% dividend yield. It just doesn't make any sense. And now if you look at trading multiples in the last 12 months, which is it's in a rolling 12 months, which is why it's different to the chart before. It's just incredibly expensive, like 4 times the book value, 63 times PE. And it's just something that I definitely wouldn't want to touch. And in order to, if you think about it, if you're paying 35 times the EBIT, you're going to wait 35 years to get your investment back if they don't grow. And so you're expecting them to make these massive growth in terms of the EBIT. But the problem is their payout ratio is so large that they can't invest that into more CapEx that would be needed to get such growth. So I just think that this is headed for disaster, and I can't believe it's trading where it is. Obviously, shorting is it's a risky game in terms of getting the timing right, and you can be right on your thesis and still not make any money. But I just thought it was interesting to bring up, and I know a few people are talking about it, and I just thought I'd give my overview and 2 cents here before I show you exactly, before I show the private members exactly how I'm playing it. So let's take a look here. Free cash flow is bleeding. It's just crazy. When you look at the cash from operations over the last 12 months, then you look at the capital investments that they're making, that they're just bleeding cash everywhere. And if that wasn't bad enough, you've got to pay through the nose in order to buy the sector. And so I'm not interested in that at all. All right, how to profit. So you can short. This is what I'm looking at doing in the eToro portfolio. I'll be taking out a short position and keeping a close eye on it. So obviously with shorts, things can go wrong, but I'll be putting in a stop loss. And I think that that'll provide a nice little hedge. If we see further market downturn, I'd expect these to perform even more poorly than the index in the event of a broad equity sell-off. And then in the Substack group here, guys, in the ROI Club, I've got a few different ways that I'm playing it. So put a trade on with a twist. So I've also got a way that I can generate income from the trade, and I've got a way that I can potentially 3x my money by the end of the year. So if that's interesting to you, I'll put the link in the description. And of course, you can have a free trial in the ROI Club. And yeah, well, why not join, guys? I'm getting more and more active on Substack. I've just written the monthly edition. So I've written the ROI monthly, and I'm making that one free. So the first one is completely free. So do a free subscription and you can read through that. And yeah, it doesn't cost you anything. If you want to stay on and get access to some of the more juicy stuff, you can have a 7-day trial. And what you'll expect is you get a monthly analysis that I've just written up, which will have an in-depth stock analysis, valuation, and my moves. You'll have access to exclusive interviews. I've just done a whole heap over the last 2 days with some incredible people and professional investors around the world. So I'm super excited to get them out to you. And then you'll get access to my intelligence nodes and software, very expensive to use. And so you can, I guess, you can get access to a hell of a lot of that for nowhere near the investment. I also have a master valuation sheet that I update every month. So I guess these are the biggest names that I'm interested in, and I keep updating my estimate as to their intrinsic value versus the price at which they're trading. And you can ask questions and make requests. So there's a monthly option, which is $10 a month. You can cancel anytime, obviously, on Substack, or if you commit to a full year, then it's $60. So it works out obviously to be about $5 a month if you pay annually. And so there you go, guys. It's not expensive. Most of all of the feedback I've got so far has been very positive. So I'm hoping to see you on the other side. In the meantime, please be sure to like and subscribe, and I look forward to catching up with you in a future video. Cheers.